Passive income is something that generates significant income. You don't have to pay any attention to it, and that income continues to flow out all the time.
Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. And we believe that the key to scaling and compounding your wealth starts every single day with a mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth, faith, and life so you can make a bigger impact. And we're excited about our next guest. He's going to help us do just that. He is out of the great state of South Carolina, and he is known as the Income Coach. In fact, you can find him by going to theincomecoach.net. He also wrote a book on retirement money secrets. And as well, we're going to be talking about the 4 great financial risk minimizers today. Steve brings a wealth of background and knowledge with over 40 years as a professional investment manager, advisor, RIAR, and his current adventure is coaching both individuals and other advisors in creating income independence for themselves and for their clients. Please welcome to the show with me, Steve Selengut. Steve, how are we doing?
Good, Brett. Good to be with you.
Absolutely. And for our listeners getting to know you for the first time, maybe just give us a little bit more about your story and your current focus.
Okay. My story goes way back since I'm so old and I've been in this so long. I started investing when I was 75, or in 1975, when I was, I don't even know, about 30, I guess. And mainly I started investing as a result of, putting away money as a kid when I was doing jobs and things like that. And my dad insisted that that was going to be my rent. He was going to take a piece of my employment income in the jobs I was doing and put it away and start investing it for me. And that someday I would see the benefit of doing that. So when I was 25, that all came to be at my birthday celebration, where he literally dumped this envelope, this legal size vanilla envelope, on my desk with all stock certificates of this portfolio that he and his attorney had created for me. And it was a little bigger than he might have anticipated, because I chose not to go to an Ivy League school like my brother had. So there was a lot more money that continued to be invested. So I started off at the age of 25 with almost a 6-figure portfolio, and that was actually in 1970. So that was really a lot of money at that time.
All right.
So
Excellent.
My thoughts were to never lose it. That's pretty much he said, too. This is what you're getting, buddy. Don't lose it, you know. So I started with a stockbroker and handed her the certificates, and I said, okay, where do we go from here? I've got this portfolio of stocks. I really haven't done any of this. Teach me. And I was fortunate. She taught me. She didn't take advantage of me like you might have expected. So what I happened to have was I had maybe 30 or 40 different companies, all dividend payers, every one of them. Most names you'd recognize even today, like Shell and Exxon, IBM, Sears, Roebuck at the time, and just GE, a whole bunch of them. And we didn't buy anything more or sell anything more. They all paid dividends. They were coming in. But we looked at all the charts. She showed me the charts of all of them, and their ups and downs and ups and downs. And and it was a bunch of what ifs. What if every time one of these things goes up, we sell it and buy something else? Same quality, same continue the diversification, continue the income, and so on. And buy something else in that same category, the same type of security, and just keep doing that over and over again. And we did that. And we traded frequently. We set targets. There's a story I wrote about in my first book about how I decided to take profits. It was simply, and to just make a long story short, we were going to Boeing, and my employer had all this Boeing stock in the retirement plan. We had a savings plan at that time. There were no 401ks and things like that. No IRAs, for that matter. So we had this savings and investment plan, they called it. And in it, they had a gazillion shares of Boeing. So we were going out there to talk to them about their savings plan. And I said, why do you have so much Boeing? It doesn't pay a big dividend. It pays some. But you've got, millions of dollars in profits sitting here. And they're just sitting there. Why don't you take those profits, buy some other stuff, buy some income securities, things like that. So he said to me very clearly, Boeing is one of our biggest insurance customers. They like us to have a lot of their stock in the plans that we manage, the investment plans we manage. So from that point on, my entire career, I realized that the investment game is not just economics, it's also politics.
Yeah.
It's also influence of one on another.
Okay,
and from that point on, I set a profit target in everything I owned.
Okay, awesome. And by the way, you can learn more about Steve Selengut by going to incomecoach.net. So let's dive right into the topic at hand, Steve, which is the 4 great financial risk minimizers, right? Obviously, you have tremendous background and experience, and you've seen a lot. So let's just dive right into specific. So what's the number one great financial risk minimizer? Is it diversification? Is that what maybe you would say on that one?
Close. I would put one before that.
Okay.
And that would be quality.
Okay.
Quality can be measured in many ways. When I was doing individual stocks, I'd measure it by how long they've been in business, how diversified they were as an entity, how many different products they had on their shelves, so forth. Did they pay a dividend? Very important to me. I always understood that I was an owner of this company, and I wanted to get paid. I wanted to get something for my investment. So that's why I was always buying dividend stocks. And so that was very important to me. I didn't look at a lot. Actually, there wasn't much attention paid to social issues in those days anyway. So, but those are the big quality things.
Okay, got it. Got it. Are they profitable? Are they paying a dividend? And then what's their track record? Right? How long they've been doing it for? Okay, so what's number 2? Number 2, diversification.
There's diversification. Yep. I wanted to own pretty much every sector I could think of. And as I was growing the portfolio, I was able to do that. So you make sure you had some health care, you had plenty of energy, you had all these different things. So if something good was going on, the market is very sector specific, and some get popular while others go the other direction, and you could take advantage of that. You could take the profits in the one and buy the other ones. And as long as you stayed with the quality, the diversification was just a way of really maximizing your presence. And
got it. That's why quality is number 1, right? Because if it doesn't have those, then it doesn't matter if you diversify, because you're diversifying some poor things.
Junk, right?
Junk is junk. Yeah, junk in, junk out. Okay, so number 2 is diversification, as long as it's going into quality, which is number 1. Healthcare, energy, tech, all the different sectors. Okay, what's number 3 to 4 great financial risk minimizers?
Okay, that one's income production. It's got to pay you something. If it's making money, it can pay you dividends. And not only that, but the fact that it was paying you dividends was a good way to make sure that the quality wasn't getting eroded anyway. None of these guys want to cut their dividends, and if they do have to cut a dividend, that something's really wrong with that company.
Oh, that's good. So it's kind of like a built-in auditor or a built-in stress test, right?
Right.
If you see that they're cutting the dividends, then boom, like that could be a sign that maybe a good time to sell because something's going to happen. Is that a good thought, Steve?
Right. That's exactly right. That's
okay.
it.
Have you ever found the opposite happen where they cut the dividend and you're like, oh, I wish I wouldn't have sold? I mean, or is that 1 out of 10? You know what I mean? Or what's your take on that?
When I make a decision, an investment decision, particularly if it's a profit, I never look back.
Okay. Oh, all right. So that's maybe
there's always something else. I'm going to go ahead and I'm going to buy something else immediately. I'm not even going to look at the news basically about it.
So let's talk about that mindset, right? Because people might, the fear of missing out or the regret of selling. So walk us through the mindset you've learned over the years. You said you sell, you never look back. Okay, well, are you selling all of the position all at once versus selling half of it? Or what do you mean by that? Because you might dollar cost average out, right, on a certain amount.
I typically, if the entire position is profitable, meaning all the lots inside are profitable, I'll sell the whole thing.
Okay.
And I've transitioned from individual stocks to closed-end funds.
Okay.
And I'm not sure how familiar you are with them, but they're like the other funds except that they're trust vehicles. And there's a 95% of the income they pass through to their shareholders. And they contain many securities. So I use them now, so that I am more diversified than anyone needs to be. But I like that.
Okay, got it. That's good. That's good.
So I own all the stocks that are out there within, let's say, almost 100 different closed-end funds that are into the equities.
Okay, got it.
Yes, that's important to me.
So
and they all provide the income.
Got it. All income reduction is kind of a quality check, diversification, and then mindset of when you're selling, you're typically selling, the entire all of the position, and you're diversifying. I mean, obviously there's nuance here, right? But generally speaking, yeah.
If let's say this is one that you've held a long time, and it's been a down market or something, you've been adding to it at lower prices throughout the years, and then all of a sudden the market comes back up, and little by little, one piece of it goes to become a profit. And you can still use that money, that capital, by selling it. You can use that capital to average down on something you already own, or buy new positions that are still down. So you can multiply. You can accelerate your income by doing things like that.
All right, we're speaking with Steve Selengut, by the way, theincomecoach.net, theincomecoach.net. He also has a book called Retirement Money Secrets, and so you can check that. We're talking about the 4 great financial risk minimizers. In fact, we're going to get to number 4 here in a second, but we do want to take a pause to share with you from our sponsor today, which is basically a big challenge that most people face is selling a property. It can be public stock, it could be a business, it could be Bitcoin, and you have millions of dollars of gains, and it's daunting because of this capital gains tax. It's somewhere between 20 and up to 50% of your gains are going to be taxed, depending on the depreciation recapture, and it's very frustrating. And so for most investors, the only way around it is the outdated 1031 exchange. Well, what if I could tell you there's a better way? And Capital Gains Tax Solutions has helped countless business owners and investors exit and keep more of their wealth using a deferred sales trust as a vehicle to defer the capital gains taxes to compound their wealth, and you can slowly pay your tax over time. They've closed over $500 million in deferred sales trusts and are pioneering solutions for everything from real estate to Bitcoin and everything in between. They recently helped a San Diego business owner selling a $13 million business keep an extra 40% by deferring all the capital gains taxes. Another client, their dental practice for $16 million, defer about 30%. And still another one, save their 1031 exchange using their best 1031 exit plan service. This is something Capital Gains Tax Solutions has perfected over the years, and they want to show you how it can work for you too. So don't get caught without a backup plan to your 1031 exchange. Consider their best 1031 exit plan powered by the Deferred Sales Trust. If you have an upcoming sale with at least $1 million in proceeds or gains, the 1031 exchange you are considering or Capital Gains Tax Solutions can help, but you must act before closing escrow. Visit capitalgainstaxsolutions.com to calculate your potential savings and schedule a free consultation. That's capitalgainstaxsolutions.com. Okay, Steve, so now let's go back to the show here and a little focus on the number 4 risk minimizer. So what's number 4? We talked about quality, diversification, income production. What's number 4?
Well, that would be the profit taking. Profit taking is what most people forget to do. They watch them go up, they fall in love, they're happy, they're smiling, and then we have a COVID, or we have a dot-com bubble, or something that you probably don't know about firsthand is the crash of '87. But stuff like that happens, and all of a sudden your profit's gone, and you've never realized it. So when I originally started, for some of the reasons we talked about, I always had in individual stocks. I always had if it got as high as 10%, I was taking it. I didn't care about anything else, but I would take profit sooner than that all along, because I always was able to reinvest in a broad range, a broad universe of securities that met my requirements. Today, with closed-end funds, my will not hold over number has become 5%. So I'm constantly trading, and it's mostly short-term capital gains that I'm creating now. In the protected environment of my IRAs, it's not a big deal, but in my individual portfolio, yeah, I'm creating the capital gains and paying those awful taxes.
Okay,
but I'm growing the income by leaps and bounds.
Yeah.
That's the important thing.
Hey, profit taking, right? So used to be 10% on a single stock, and now it's more like 5 on any certain positions. You're taking the profits. You're not waiting for a massive, event that could really, crush your profits. You are taking out the profits. Okay, got it. Speaking of capital gains taxes, right, Steve? I mean, what would you say is the biggest frustration when it comes to? It could be a single stock. Our strategy works for single stock owners. It could be a business. It could be real estate. But you might have clients or investors that you work with that are like, man, Steve, I want to sell my big primary home in California or New York, or my big business, and I've got these massive capital gains taxes, and it's not in a Roth IRA, and I'm about to get crushed, and I want to diversify into stocks, bonds, and mutual funds, but they don't know how to transfer the illiquid asset to the liquid assets without getting crushed by the capital gains taxes.
Well, I'm not an accountant or anything like that, so I don't really try to advise people in that, particularly on the real estate and selling of that kind of stuff. But if they have, like a lot of my coaching clients and past management clients have, when I see them first, is they have large positions in individual securities that break all the normal diversification rules. I mean, I've had people with literally a couple $1 million in just 3 or 4 different securities, which really makes me pull my hair out, But what we do is we set up we just set up a plan of liquidating like 25% in a year to get that moved into other areas. And with the income we're making in a year, if you took $1 million in profit, for example, you're going to pay $250,000 in taxes on that, right? Or is it 15%? Depends.
Well, it depends on what income bracket you're in. Yeah,
but even so, you're gonna make, if you're investing in closed-end funds like I do it, you're going to make simple base income of $100,000, and if you have a good year like we had this year, you're probably going to add another 20% to that in capital, again, taxable, but still capital gains. So, in other words, you're kind of cutting the pain of the taxes with the income you're making, but the secret ingredient is to be taking your profits all along and not to just hold on to a security, because typically those securities are paying almost nothing in income. Even if they're good dividend stocks that you've held that long, the average yield is probably in the 2% area, 2 to 3%, when you could be making 10% in closed-end funds. It just boggles the mind that people hold on to stuff that long.
So here I am. Okay, so but imagine you are there, right? And in fact, we've helped people in this exact situation. You want best of both worlds, right? So you've bought and you've got up millions of dollars in your stock. It could be public stock, it could be private stock, it could be Bitcoin, business, real estate, and you have these massive capital gains taxes. In fact, we helped one client. They bought Bitcoin for about $50,000 a coin, and it went up to $50 million. And we exited $5 million, and we diversified them into some stocks, bonds, mutual funds, as well as they have able to go into a business venture. And this is before the last Bitcoin kind of crash. And so we've done it with stock people who own like large positions in public stock. And so the idea here is to build what's called a capital gains tax exit plan. It doesn't require an IRA or 401k or a 1031 exchange. And you build these, and it can receive the capital as a trust and issue back a promissory note, and then it can be diversified. And also it can start to produce income, right? And so we think it's the best kept secret, Steve. Most people don't know how to do this, but we've perfected it. And we wrote a book on it called Building a Capital Gains Tax Exit Plan. And that's exactly what we do. We help people position themselves for a plan to exit and then to be able to invest. And Steve, if you're managing capital for clients, perfect, right? They can invest with you. And that's the whole idea, like have extra for Steve to manage so they can diversify more, as well they have extra wealth to live off of. And typically they just live off the interest, and they just pay they just pay ordinary income as they receive interest payments back, but they have an extra 20, 30, 40, 50%.
So from the trust, they can take the income.
Yes, sir.
Okay, and is the trust tax, or does it pay out 95% of the income?
Yeah, so typically the trust is never taxed, and the reason is because the trust bought the position. Let's say it's a $10 million worth of stock.
Bought it at the cost.
Bought it at $10 million, sold it at $10 million to the market, so it has no gain. And then it issued a promissory note back to the original seller. Let's say it's at 8%, so it's $800,000 is the goal to earn on average every year, and it can be 7 or 6 or 5 depending on their risk tolerance and where they want to go. And so they get a note back. They get it for $10 million, and then instead of having, let's say, $7 million to invest, they have 10 in the trust, and they typically just live off of, let's just say, $700,000 at 7% per year. And they're really happy because they're like, well, I got an extra $3 million working for me, right? So it's a win-win. Financial advisor has more to manage. Investor has no holder in this scenario has more to pay, and they'll pay taxes. They receive payment, and ultimately, actually, the person who wins the most is the government, because it creates more jobs, because the monies go into stocks, it goes into business, goes into other things that ultimately should hopefully stimulate the economy to create more jobs. It's the same concept of an IRA and 401k. If we just took all the money and didn't put it in there, we're less likely to grow the economy. So this incentivizes the seller to sell these highly appreciated positions, unlock that capital, redeploy it into other investments, which spurs economic growth. It's a win-win.
I can see that.
Yeah. So if you want to learn more, you go to capitalgainstaxsolutions.com. Or get the book Building a Capital Gains Tax Exit Plan on Amazon. Okay. That being said, we're running out of time. Mr. Steve, are you ready for the lightning round?
Fire away.
All right.
I didn't know we were going to have one. Go ahead.
No, that's why it's the lightning round. And it comes on you fast. So, knowing what you know now, if you could go back to your 20-year-old self, what's the one golden nugget make sure you tell yourself to do?
Keep your eyes open for high-income opportunities like the closed-end funds I didn't start investing in earlier.
Okay, excellent. Question number 2, what's your number one book you've recommended or gifted the most in the past year?
Retirement Money Secrets.
Okay, perfect. Question number 3, what are you most curious about right now?
What am I most curious about? I'm 80 years old. I'm not curious about a whole lot of things. But I'll tell you what I am curious about. I'm really curious about what walking around in one of the big cities in India is really going to be like, because I'm going there in September.
All right.
And I kind of know what I think I'm going to see, and I'm hoping I don't, but I think it's going to be a lot of poverty and stuff like that. And we'll see. I'll see what that part of the world is like. So
okay.
I am curious about that.
Okay, excellent. Next question, number one leadership quote or theme that you strive to live by?
Market value fuels the ego. Income fuels the yacht.
Oh, I like it. Next question. How do you define truly passive income?
Passive income is something that generates significant income. You don't have to pay any attention to it, and that income continues to flow out all the time. And, you should pay more attention to it and perhaps take profits and stuff like that. But in general, if you do the other QDI stuff and it's just there, those things could just keep paying out 8, 9, 10% every year. You don't have to do a thing.
I love that. Don't have to pay any attention to it. Last question, and it's basically the heart of the show. And what we're about at Capital Gains Tax Solutions, which is practicing a mindset and a daily practice of stewardship over ownership. So when you hear that, what does stewardship over ownership mean to you? And maybe what's the way that you practice that?
Oh, stewardship over ownership. Well, I've always kind of been a steward because I've been managing other people's money. And the way I felt about capital gains, without the amounts weren't the types in the millions and things that you were talking about. These would be, at most 100,000 or so a year, spread over the course of the entire year, and reinvested for generating more income. So every year we would grow working capital and grow the income for each person. Okay, and the capital gains they paid, even if it were 30%, they still had 70% working. So the growth, even after tax. I mean, I just paid my estimated tax bill for the final one before the taxes. So more than half of that I've already earned back in distributions since the beginning of the year. You know what I mean? So I grew income and I grew distributions faster by reinvesting both the distributions and the capital gains to get people to the point of income independence. So I stewarded them to get there, and they got the income independence.
It's a great way to wrap up the show, Steve. I want to thank you for being on the show. I want to encourage you to keep using your gifts and talents to help people unlock, financial freedom, lower their financial risk, using, quality diversification, income production, profit taking, and ultimately help people to be great stewards with their wealth, right? And for our listeners who want to get in touch with you, could you remind them one last time what's the best place for them to find you?
Theincomecoach.net.
Perfect. Thank you, Steve, for being on the show. I also want to thank all of our listeners for listening to another episode of the Build to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channel. And we're on this journey with you to guide the successful entrepreneur or investor on your journey from millions to billions. And we encourage you to take great notes when you're listening to folks like Steve on how to minimize your risk, right? And how to build plans that can give you true diversification, liquidity, and the ability to make great decisions with your wealth as well. We encourage you to plan for your exit. If you have a huge capital gains tax liability of $1 million net proceeds, $1 million gain coming up with public stock, private stock, Bitcoin, real estate, business, really any asset of any kind, go to capitalgainstaxsolutions.com and get the free ebook and get started. We have a consultation, myself or one of my team members, to help you out. You can also buy our best-selling book called Building a Capital Gains Tax Exit Plan. We have Kevin Harrington from Shark Tank in the book. I know there are other really smart individuals in the book as well, and I have a couple chapters, of course. And it's my journey from helping my clients exit and eliminate forever the 1031 exchange so they can have flexibility with their wealth. Go to Amazon to check out Building a Capital Gains Tax Exit Plan or capitalgainstaxsolutions.com. Appreciate everyone listening and watching out there. And please rate, review, subscribe, share this with someone it can be of value to. And we'll talk again soon. Bye now.